How the stock market actually works. Most people have heard of the stock market. They know it goes up and down. They know some people make money from it and others lose money. But very few people actually understand how it works. In this video, we're going to change that in plain, simple English. What is the stock market? The stock market is essentially a marketplace, just like a farmer's market or an online shop. Except instead of buying fruit or clothes, you're buying and selling small pieces of companies. These small pieces are called shares or stocks. When a company wants to raise money to grow its business, it can sell shares of itself to the public. In return, buyers of those shares become part owners of that company. If the company does well and grows, the value of those shares goes up. If the company struggles, the value goes down. Where does the stock market actually exist? In the UK, the main stock exchange is the London Stock Exchange, or LSE. In the United States, the two biggest are the New York Stock Exchange and the NASDAQ. These exchanges are the official platforms where shares are listed, bought, and sold. When you buy shares through a broker or an investment app, you're essentially placing an order on one of these exchanges. The exchange matches your buy order with someone else's sell order, and the trade is complete. How are stock prices determined? Stock prices are determined by supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. But what drives people to buy or sell? Many things: company earnings, economic news, interest rates, political events, and even public sentiment. This is why markets can be unpredictable in the short term. In the long term, however, stock prices tend to reflect the true value and performance of a business. Who is involved in the stock market? It's not just individual investors like you and me. The stock market includes large institutional investors like pension funds, insurance companies, and hedge funds. These players buy and sell enormous amounts of shares every single day. There are also market makers, firms that ensure there's always a buyer and seller available, keeping the market liquid and functioning smoothly. What is a stock index? You've probably heard of the FTSE 100, the S&P 500, or the Dow Jones. These are stock market indices. An index tracks the performance of a group of companies. The FTSE 100, for example, tracks the 100 largest companies listed on the London Stock Exchange. When people say the market went up today, they're usually referring to one of these indices. How do you make money in the stock market? There are two main ways. The first is capital growth. You buy shares at a lower price and sell them at a higher price later. The second is dividends. Some companies pay out a portion of their profits to shareholders on a regular basis, providing a passive income stream. What causes the market to crash? Market crashes happen when widespread fear causes large numbers of investors to sell at the same time, driving prices sharply down. This can be triggered by economic recessions, financial crises, pandemics, or geopolitical events. History shows that while crashes are painful, markets have always recovered and gone on to reach new highs over time. Final thoughts. The stock market is not a casino. It's a structured, regulated system that allows businesses to raise capital and investors to grow their wealth. Understanding how it works is the foundation of becoming a smarter investor. The more you learn, the less intimidating it becomes. And that's exactly what MarketIQBasics is here for. Breaking down the complex world of finance into simple, actionable knowledge. If this video helped you, please like, subscribe, and share with someone who needs to hear this. See you in the next one.